Hi, everyone. Welcome and thank you for joining us for today's webinar, The Great Retirement Income Gap, presented by Mueller Financial Services and featured speaker Heather Olson of OneAmerica. Before we begin the presentation, I'd like to just go over a few housekeeping items, some of which were explained in the welcome message when you entered the webinar, but I will share them again here. So questions asked during the registration process have either been incorporated into the presentation or will be answered at the end of the presentation. But we will not be able to take live questions at this time, like you would in your questions box in the control panel. But any questions following the presentation, our contact information will be available to you so that you can get in touch with one of our representatives. We also will not be able to provide you with a copy of today's slides, but we do hope to be able to provide you with a recording of today's session in the next upcoming weeks. Once it is available, we will happily share with all of our attendees, and it will be available on our website. Last thing, more information about Mueller Financial Services is available for your viewing in the handout section of your control panel, and that's there if you'd like to learn more about Mueller Financial Services process and values. And with that, I will hand it over to Lisa, who's one of our wealth advisors at Mueller Financial Services. And the floor is yours, Lisa.
Great. Thank you so much, Emily. And I want to thank all of you for attending today. I would like to give you a little bit of background about Mueller Financial. We are a full financial planning service firm offering our clients ongoing education, as in today's seminars, and customized financial plans, investment strategies, and insurance needs. And we have been servicing our clients for over 30 years. I'm going to go a little bit of background about myself. I have joined Mueller Financial as a wealth advisor last year with over 22 years of experience in the industry. And I really am truly passionate about helping our clients work towards and determining their financial needs and customizing a financial plan that guides them on a path to achieve those goals. From the planning process, including estate planning, identifying insurance needs, all the while navigating through our life changes that we all, that all happen to all of us along the way. And with that, it's my pleasure to introduce Heather Olson with OneAmerica. She has extensive experience working within multiple levels of the financial services industry, helping advisors and their clients with their wealth accumulation, protecting their income, preserving their estate, and wealth transfer. Heather has worked at leading industry companies covering annuities, investments, life insurance, and long-term care products that help clients achieve their long-term financial success. I have personally worked with Heather for a number of years. I've witnessed her expertise and knowledge, and I'm happy that she is able to join us today and share that knowledge on the very important topic of long-term care insurance. And with that, I'd like to introduce Heather.
Thank you, Lisa. Good afternoon, everybody. My name is Heather Olson, as Lisa had said, and I work for OneAmerica. And I want to thank you first and foremost for taking time out of your day to attend this session, which we are going to be speaking about the great income gap when it comes to retirement planning. And we're specifically going to stay focused more on the topic of long-term care. So during this presentation, this is really educational to make you aware of what the costs are associated with long-term care, some of the trends that we see, as well as taking a look at protecting assets should there be a care event, as well as looking at some examples of some tools that could, in fact, protect your portfolio from a care event, whether that be in your home or perhaps in a facility. So let's get started. When it comes to preparing for retirement, if you think about it, you can parallel it to mountain climbing. Now, if we were all in a room together and I asked the question of where do you think more people die, on the climb up to Mount Everest or on the descent? And for those of you that said on the descent, then you are correct. More people die on the descent. Why is that? The reason being is they're more focused on getting to the peak, getting to the top, the anticipation of getting to the top, and they're not as focused on that climb down. And I read an article recently that said getting to the summit is optional. Getting down is mandatory. So if we were to parallel mountain climbing to retirement planning, you have the climb up as the accumulation phase, which is saving, putting away money for retirement to get to the top, which is our retirement date. And then once we hit retirement, getting to the descent or the distribution phase. Many people are focused really on the accumulation phase and don't understand that it is more imperative to focus just as much on the distribution phase or that climb down the mountain. So a good financial plan doesn't end at retirement. It's actually a work in progress. So it makes sense to continue to work on that distribution phase. And if you think about the challenges that many people face in retirement, particularly the baby boomer generation, they have some challenges that no other generation has ever faced before. And if you think about when the baby boomers entered the workforce, you had the beginning of the demise of the defined benefit plan and really the startup of the defined contribution plan. So we've seen a shift of responsibility for planning for retirement go from employer to employee. So with that, there comes some challenges. And the first challenge is longevity risk. And that really has a snowball effect on everything else. So longevity is really how long we're going to live. The longer we live, the longer our assets need to last, and the more the markets are going to come into play. So with retirement, you have longevity risk. You also have market risk because we need to have that money working for us and growing over time, or at least a portion. In addition, you have sequence of return risk. If you start out retirement where the first couple of years you see a down market, that can really have an impact of the longevity of your portfolio. But if you experience positive returns during the first years of retirement, it also has an impact of your portfolio lasting longer. So the sequence of returns in retirement are also very key. In addition, you also have withdrawal risk. How much can you take out of your portfolio without running the risk of running out of money? Some studies prior to the tech bubble bursting in the early 2000s, clients were able to take out 7 and 8% from their portfolio, and it worked. After the tech bubble burst, studies showed that 4% was the safe withdrawal rate. Fast forward to a couple of years ago, some studies showed that 2.8% was what somebody can take out from their portfolio without running the risk of running out of money. You increase your withdrawal rate, you increase the probability of running out of money. In addition, you have inflation risk. Now, we've seen inflation be relatively low over the last couple of years. However, we've seen inflation rear its ugly head just over the last year. So we need to make sure that we can maintain the same purchasing power over time as today. So if we see an increase in goods and services, we need to make sure that we can maintain that purchasing power. In addition, you have healthcare costs. Now, this is the number one concern of most retirees out there. In fact, there was a study that was put out by Fidelity that said the average person preparing for or in retirement will spend about $280,000 in healthcare costs over their retirement years. That doesn't include long-term care costs. Long-term care costs are over and above healthcare costs, and long-term care could entail needing some form of assistance, whether it be in the home or in a facility for a year, 2 years, whatever that may be. So what is the actual cost of long-term care? When you take a look at the national average, the average cost for a private room across the country is about $105,000. Now, I would imagine that most of you are in the Chicagoland area. I'm in Chicago. That cost is actually much higher. I will put this caveat out there is that pre-pandemic, 9 out of 10 people wanted to stay in their own home for receiving care. And as an insurance company, that's where we see most of the claims start. People only transition into facility care if absolutely necessary because it's no longer safe for them to be at home. But if we look at the overall cost of facility care, it's about $105,000. If we were to apply a 3% inflation rate to that $105,000, 10 years down the road, you're looking at a cost of a little over $142,000. And 20 years down the road, you're looking at a cost of about a little over $191,000. Now, there are some trends that we see as a company that could impact the overall cost of care and drive it up even further. So we're going to look at some of those trends that we see. The first trend is higher demand. Now, we anticipate that the baby boomers will need some form of care. Some will need some form of care starting in about 5 to 10 years. So the question is the supply may not be there to meet the demand. So if the supply isn't there to meet the demand, then it's going to drive up the overall cost of care. Now think about this. The first baby boomers are going to turn age 80 by 2026. The second trend that we see is the fact that because of the medical advances and technological advances, we're living a longer life. And the longer we live, the higher the probability of us needing care over an extended period of time. Think about this. Over the last 100 years, our life expectancies increased 30 years. And since the first baby boomer was born, our life expectancies increased 13 years. So the longer we live, the higher the probability of us needing care over that extended period of time. The third trend that we see is family dynamics. Now, I like to use my family as a typical example. Sometimes we move for opportunities. And what do I mean by that? Is I grew up in northeastern Pennsylvania. My mother and my sister are still there. So for those of you that are Office fans, I grew up south of Scranton. My mom and my sister are still there. My father lives in Florida. My father-in-law and his wife live in Vermont. My mother-in-law lives in Kentucky. My husband, children, and I are in Chicago. And my brother-in-law and his wife are in Florida, different part from my father. If mom or dad or mother-in-law or father-in-law need help or assistance, need some form of care, we can't drive 20 minutes down the road and help out mom or dad should they need some form of care. So we need to rely on others to provide that care, which again could drive up that cost of care. The fourth trend that we see is government programs. And Medicare and Medicaid are not viable options when it comes to covering long-term care. A lot of times there's a misconception that Medicare will pay for long-term care costs, and that is not true. Medicare will pay for skilled nursing care or rehabilitative care if and only if there's a triggering event. And that triggering event is a 3-day hospital stay. So if there isn't a 3-day hospital stay, no triggering event. Medicare will pay for the first 20 days of charges, approved charges for either skilled care or rehabilitative care. From day 21 to day 100, there's $194.50 copay each and every day that is the financial responsibility of the patient. By the way, that number last year was $174.50. This year is $194.50. So from day 21 to day 100, there is that copay of $194.50, which is the financial responsibility of the patient. After the 100 days, all financial responsibility rests on the shoulders of the patient. The whole purpose of the skilled care or the rehabilitative care is to get the patient back to or as close to the condition that they were in prior to the hospital stay. If during that 100-day period the doctors feel as though the patient has plateaued, the patient will be released from care and all financial responsibility will rest on their shoulders. Now, Medicaid is means tested, and I don't pretend to be an expert when it comes to Medicaid planning. Depending upon the state that you're in, as well as whether or not you're a single person that needs long-term care, whether you're a couple where both need long-term care, or whether you're a married couple where one spouse needs care, there's certain limitations as far as how much assets that individual can keep as far as the community spouse not needing care. So there's asset and income limitations when it's a couple where both need care. But every state is different, and I don't pretend to be an expert by any stretch of the imagination, but it is not a viable option when it comes to covering long-term care because there is a spend down of assets. Now, the last trend that we see is Alzheimer's. And with Alzheimer's, right now in this country, there are over 5 million people that have been diagnosed with a disease. And because of that, that equates to one person is diagnosed with a disease every 66 seconds. If there's no cure found, by mid-century, you're looking at 13.8 people being diagnosed with the disease over the age of 65, which equates to about one person being diagnosed with a disease every 33 seconds. And this is what can have a dramatic impact on the overall financial plan, especially if there is a catastrophic diagnosis such as Alzheimer's. Now, a lot of times I get asked the question, well, what's the average length of care? Isn't it about a year or two once somebody needs long-term care? And it really depends. So the average length of care, non-cognitive, for a male is about 2.2 years. For a female, you're looking at about 3.7 years. So thinking about the cost of care 20 years down the road, you can see what that impact can be. Once there's a cognitive impairment, you're looking at the average length of about 8 years. Now, here's the thing about this is when you look at the numbers for the 2.2 years and the 3.7 years, this is once they enter a facility. We don't know what it looked like prior to entering the facility. In other words, did they receive care at home? Did they receive care from a family member that was unpaid, or did they pay for in-home care out of pocket? We just don't know those numbers, but this is the length of stay once they enter into a facility. So as you can see, with the averages, they may be shorter, they may be longer. We've seen instances where somebody diagnosed with Alzheimer's will pass within a year of diagnosis. On the other end of the spectrum, we see people that have been on claim with our company, which our longest claim is about 17 years with Alzheimer's. So you can really see that there is, it's skewed. It's all over the board. So with that being said, who is going to need care? And when you look at the statistics, according to the Department of Health and Human Services, 70% of individuals 65 and over will require some form of care at one point in their lives or another. It could be for a short period of time, or it could be for a longer period of time. So 70% of individuals 65 and older will need some form of care at one point in their lives or another. Of that 70%, 20% will need care for 5 years or more. Thinking about that and looking at that, what is long-term care? long-term care has different meanings to different people. And when I usually will ask the question of, what do you think of when I say long-term care? What I typically will hear is it's facilities, it's old age, it's expensive. And yes, I guess it could be that, but long-term care can happen at any point in time. And long-term care is just another expense that you may or may not incur in your retirement years. The insurance is quite possibly the vehicle that can create the tax-free cash flow if ever that expense comes into play. So long-term care is just another retirement expense that you may or may not incur. The insurance is really the vehicle that will create that tax-free cash flow if ever that expense comes into play. So thinking about it from a conceptual standpoint is, in your retirement years, what could cause your income needs to suddenly skyrocket? Where if, let's say, you needed an increase in overall income of 50 to 70%, most of you would say catastrophic medical or perhaps a care event. So thinking about that, that's what we look at as really the great income gap, is where you see that there's a sudden increase in the need for income during a retirement years. What we want to do is we want to backfill and really find a way to efficiently fill that gap. And that would be using perhaps a policy that would create that cash flow if ever that care expense comes into play. So looking at this example, this will show you what we refer to as the great income gap. So here's an example of a 65-year-old couple that retires, living off of an income every year. At age 75, they incur some health expenses, which is built into the overall plan. It's when there's a diagnosis of Alzheimer's where you see that increased income need until the end of life. And what we want to do is we want to fill in that gap and alleviate the pressure off of the portfolio so it can do what it's meant to do, and that's generate income, grow over time, and help ensure that legacy desires are met. So thinking about the great income gap and long-term care is not an asset issue. Long-term care is an income issue. What do I mean by that? A lot of times what I'll hear from individuals is that they're going to self-insure, and they may have plenty of assets to do so. But self-insure is really self-funding. You really can't call it insurance because with insurance you get leverage. It's self-funding because you're not getting any additional leverage on your own dollars if you decide to self-fund long-term care. But that decision to self-fund long-term care has a snowball effect on some other factors in the retirement plan. What do I mean by that? Is how do you come up with that additional income in retirement? If you needed to pull additional dollars from the portfolio, the first thing to take into consideration is, are the markets up or are the markets down? If the markets are up, no problem. But if the markets are down, you may have to sell some assets and realize those assets or realize those losses. The second thing is how is it going to impact the overall withdrawal rate? We increase the withdrawal rate, we could potentially impact the longevity of the portfolio lasting. The other thing to take into consideration is where is that money coming from? Is the money coming from pre-tax accounts such as IRAs and 401ks, or is it coming from after-tax accounts? If your wealth is like many Americans where the bulk of their assets are in qualified accounts, you may have to take out more to net the number needed after taxes. Then the next question becomes, is that going to bump you up into a higher tax bracket? The other thing is will it bump you up into the next income threshold for Medicare purposes, and now you've just locked in potentially higher future Medicare premiums? So when it comes to self-funding, it's not a matter of do I have plenty of assets? It's, can I generate the income and not impact the other parts of the plan? So thinking about that, what we want to do is we really want to take a look at what are the options out there. So the first option I had just mentioned and reviewed is the self-funding option. The second option would be purchasing perhaps a traditional long-term care policy. With that, with a traditional long-term care policy, it's a policy that you pay into where you pay premiums, and if you need care, it starts paying out to help offset that cost of care. The thing with a traditional long-term care policy is, number one, it's a use it or lose it proposition, meaning that if you never need care, there is no money that passes to the beneficiaries. The other thing to take into consideration is those premiums are not guaranteed. So those premiums could potentially go up over time. Where we saw a number of insurance companies in the early 2000s offering traditional long-term care policies, we've really seen that market shrink dramatically, and more people are gravitating to what we call asset-based long-term care policies, or maybe you've heard the term hybrid long-term care policies, which we're going to cover right now on this slide. With a hybrid policy, it's either going to be on a life insurance chassis, which has a long-term care rider, or it's going to be on an annuity chassis with a long-term care rider. So I'm going to stick with the life insurance chassis example. And with these policies, an individual can purchase a life insurance policy, or a couple can purchase a life insurance policy and both be covered on the same policy. The life insurance policy would provide a death benefit, which is going to be based on age and also health. So the younger an individual is, the more leverage they get. The healthier they are, the more leverage they get. So we can carve off either assets, maybe earmarked already for a care event or a catastrophic medical event, or we can carve off income from the portfolio and put it into a policy. The policy provides a death benefit. So if we're looking at a couple, the death benefit would pass tax-free upon the second spouse's passing if care was never needed. So it passes tax-free to the beneficiaries. If, however, long-term care is needed, so an individual is unable to perform what we call 2 out of the 6 activities of daily living, so that would be feeding, bathing, dressing, toileting, continence, transferring, or they were diagnosed with a severe cognitive impairment, the insurance company would start paying out that death benefit on a monthly tax-free basis. So as the insurance company is paying out those benefits, the death benefit is getting reduced on a dollar-for-dollar basis. If the death benefit runs out because of the length of care, now an optional rider, in this example, is going to kick in and continue to pay for as long as either spouse or both spouses may need care. So the money that's paid out of this policy is going to not count as income for federal income tax purposes, and it's not going to count as income for Medicare purposes. It's really, what it's doing is it's putting a limit on how much of the overall portfolio is exposed to pay for care. So if somebody needs care in their home, the policy will pay out those benefits to help offset the cost of in-home care. If they needed to transition into a facility, then it would also help offset the cost for facility care. So let's take a look at how these policies work. If you think about the policy, there's really 2 pieces to each of these policies. There's what we refer to as the base policy. Now, the base policy, as I had mentioned earlier, could either be a life insurance policy or it can be an annuity policy. The nice thing about these solutions is they can really be customized and tailored depending upon the source of funds. So if an individual wanted to write a one-time check, they can do that and have a policy. If they wanted to pay annual premiums, they can pay annual premiums and set that premium paying period for 5 years. So they pay premiums for 5 years and they're done. They can pay premiums for 10 years, 20 years, or to age 95. In addition, if the bulk of assets are in IRAs, qualified accounts, we can use qualified accounts as perhaps an option. In addition, if somebody has an annuity where income is not necessarily needed and long-term care is a concern, we can do that as well. So thinking about that, there's many different ways to fund one of these policies, and the money would go into the base policy, which is, again, is the life insurance or the annuity, and it's going to be spent down first. So the base policy is where the cash value is, that's where the death benefit is, and that's what would pass to the beneficiaries if care was never needed, but that's the portion that's spent down first. The second piece of every policy is an optional rider, which we refer to as a continuation of benefits rider. So in this example, it's going to pay additional lifetime long-term care benefits. So we can have benefits for a set period of time, or in this example, as the slide shows, lifetime benefits. But we spend down the death benefit first, and then if we get into the rider, it just continues to pay for as long as stipulated in the policy, and that has to be determined at issue by the client. So we're going to take a look at two examples. We're going to look at a life insurance policy example, and we're also going to look at an annuity policy example. Keep in mind that we just want to show one example of each, just to give you an idea of conceptually how this would work. Understanding that everybody's situation is different, and that these policies can really be customized and designed to fit your needs and your situation, because nobody's situation is the same. Everybody's situation is unique. Everybody's experiences are unique as well. So the best thing to do regarding a conversation with these policies is to set up some time to have that discussion with Lisa. So we're going to take a look at a lump sum example of we're going to look at a couple, and this is on the life insurance chassis, where they are both age 60. They've done a great job saving for retirement, and they are concerned about a care event. And the reason being is they have a family history of Alzheimer's and Parkinson's, and they just want to make sure that they don't run out of money and that they can be covered if ever there's a care event. So they really want to cover the catastrophic and have lifetime protection on a policy. So they're going to do a single premium of $200,000. That $200,000 is going to go into a life insurance policy, which is going to provide a death benefit based on their age of $227,407. So if they never needed care, once the second spouse passed away, $227,407 would pass tax-free to their beneficiaries. If, however, either spouse needed care, they would have $81,867 paid tax-free annually, which would equate to about a little over $6,800 per month tax-free. So that would help offset the cost of either in-home care or facility care. If they both happen to be on claim at the same time, they would each have $81,867 tax-free. If one were on claim because they couldn't perform 2 out of the 6 activities of daily living, or they were diagnosed with a severe cognitive impairment, we would start paying out those benefits on a monthly basis, and at the same time, the death benefit would be reduced on a dollar-for-dollar basis. So if the full death benefit was spent down, now that lifetime rider would kick in and continue to pay those benefits for as long as needed. So thinking about what that would look like if somebody were to need to generate that income because they wanted to self-fund, they would have to have over a 40% return to generate that same $81,000 on a $200,000 investment. So as you can see with these policies, you're getting leverage, but you're also getting the income, which is not going to be taxable as far as income tax purposes, or is not going to count as income for Medicare purposes. Now, this was just one of many examples that we could have shown for the life insurance chassis, but this is really to give you an idea of how this policy would work and generate some of that cash flow and alleviate the pressure off of the portfolio if there was a care event. The next example we're going to look at is using an annuity example. So it's a fixed annuity that pays a guaranteed rate of interest, which has a long-term care rider. So we're going to look at an example of a 63-year-old female that has some money for a care event set aside. She's recently retired, has good pension income that's going to provide her the necessary income to live in retirement. She doesn't have children and wants to make sure that she's covered for care and wants to ensure that the insurance company can pay her care provider directly should there be a care event in her life. So she's going to put $150,000 into an annuity, which is going to pay a fixed interest rate. She's also going to have to do a cognitive phone interview in order to get additional leverage over and above her $150,000. So by answering no to about 5 questions and doing a cognitive phone interview, she's going to get additional leverage of $225,000. So now by putting $150,000 into a pool or into an annuity, she has a pool of long-term care benefits totaling $375,000, which would pay out if she needed care for a 5-year period, totaling $75,000 tax-free, which equates to about $62.50 per month to help offset the cost of either in-home care or for facility care. So this was just an example of the annuity example, which has minimal underwriting on this solution. So here's what I would say is thinking about long-term care. It's not top of mind for anybody, but it is part of the overall risk management strategy. And thinking about the plans that you have in place or your situation, what I would ask is that you have a discussion with your spouse or your loved ones regarding a care plan. And what I mean by that is not necessarily an insurance policy, but having a written plan in place should something happen to you. A couple of years ago, in 2017, my father called me. I was traveling for work. I was with an advisor. It was about 5:30 at night. And long story short, I saw he called. I figured he was just checking in. He ended up falling. The titanium rod to his hip, on his hip replacement, snapped in half and he fell. He had surgery, which lasted 8 hours the next day, was in rehab for 2 weeks, and then was in outpatient therapy for quite a while. My sister and I both went down to Florida at different times, just helping him out. And sitting at the table with him, he was in his wheelchair and I was sitting at the kitchen table. We were having a glass of wine. And he said, "I appreciate that you came down and that your sister came down. I never want to be a burden to either one of you. And every decision regarding my care has been made." So he has a long-term care policy in place, but above and beyond that, his medical directives, everything that he wants, he's made the decision to do so that we don't have to make that decision, because he had to make that decision for his own father, and it was a stressful time that weighed on him. So when it comes to a plan, what I would say is seeing how the overall insurance can fit and protect the overall financial plan, protect legacy desires. And what I would suggest is that you sit down with Lisa, schedule some time with her to see how this would work into your unique situation, and also make sure that your family's aware of your desires. I want to thank you for your time, and I'm going to turn it back over to Lisa.
Great. Thank you so much, Heather. That was a lot of wonderful information and important information, especially in this day and age of everybody living longer and having that longevity risk. Wanted to emphasize again what Heather had said, that there are many different long-term care policies out there, and then many different ways to fund them. I want to take a moment, and we did get some questions sent in. So if Heather, we can answer some of those questions now, that'd be fantastic. Can you go into some more detail around what long-term care policies cover?
Okay, Lisa, I apologize. I don't know if
Yes.
you saw the panic on my face. I accidentally, instead of hitting mute, I hung up, so I had to dial back in.
Oh, okay.
So can you
didn't know
repeat that question? I did.
Sure, absolutely.
I'm so sorry.
Absolutely. No, it's okay. Can you go into more details around what long-term care policies cover?
Sure, absolutely.
Facilities
So
at
with
home?
With these policies, they cover in-home care, they cover assisted living, they cover respite care, they cover facility care, adult daycare. So these policies do cover a whole spectrum of care, where back in the day, 30, 40 years ago, traditional long-term care policies, you either had to buy a nursing home policy or a home care policy. With all of the policies that are available today, they cover everything. So they'll cover in-home care, facility care, assisted living, respite care, adult daycare, and in some cases, home modification to a certain limit.
Okay. And then I guess the great follow-up question that we got to that would, I know you spoke about them, a triggering event. So what would a triggering event be to, for a long-term care policy to start paying out, I should say?
So the triggering event would be that a doctor has to diagnose, their own doctor has to diagnose that they are unable to perform 2 out of the 6 activities of daily living. So feeding, bathing, dressing, toileting, continence, transferring. Or they're diagnosed with a severe cognitive impairment. So at that point, if their doctor said that they couldn't either do one or the other, or 2 of the 6 ADLs or cognitive impairment, they can file a claim with OneAmerica, and our claims concierge would work with the family in helping them file that claim, and then it would either pay for the in-home care or facility care. And what's nice is there's 2 ways to go about how these policies are paid out. So the most utilized one is, as long as the care provider is licensed, it has to be a licensed care provider, so whether it's in-home or facility, if they send an invoice directly to the insurance company, OneAmerica in this example, we will pay them directly. So it eliminates paperwork, submitting receipts. It's just working with the family initially and then working with the facility or the licensed care provider thereafter to pay the bills directly.
Okay, great. Another one that we got would be, what are the underwriting procedures? I know you touched on it briefly to get a policy in place.
For the life insurance chassis with the long-term care rider, there's some health questions. I mean, for both policies, there's what we refer to as ineligible impairment. So they would disqualify them from any policy. But with the whole process, if somebody wanted to move forward, they would sign a HIPAA form. There's a phone interview that asks some medical questions. If anyone is 60 or over, there's an automatic cognitive phone interview. So they're making sure that somebody isn't already cognitively impaired. And then the underwriters will get the phone interview results for both the medical questions as well as the cognitive phone interview. Sometimes they will just immediately approve them. So it's what we refer to as expedited underwriting, because there's little health history, they're very healthy. If, however, there's some health history, we may have to move it over to what we call full underwriting, where we're going to request medical records from the doctor. And then once we get those records, the underwriters look at it and then they make a decision. The annuity is very minimal. So they have to answer no to 5 questions. Again, they can't have any ineligible impairments. In addition, we pull what's called a Medical Information Bureau report. So we just pull a report on them. And we also pull a prescription report, making sure that they're not on some of the ineligible prescriptions. If they wanted additional leverage over and above what they put into the policy, they would do a cognitive phone interview as well.
Okay, great. We just have 2 more that we got. How much life or long-term care insurance should I purchase?
Everybody's situation is different, meaning that we're not necessarily trying to cover the full cost of care. And because everybody's situation is different, it's imperative to sit down and look at it from the standpoint of what cannot be redirected from the portfolio to pay for care, because otherwise it's going to disrupt other parts of the plan. So everybody is different. We're not trying to cover the full cost of care, although some people want that, but that's not the norm with the clients that we're working with. Is we just really want to make sure that their plan is not disrupted, so everybody can be different as far as what that amount might be.
Okay, and then the final one, and I think that probably parlays into exactly what you had just said, but at what age should you buy a long-term care policy?
The younger you are, the better. With that being said, is people have financial obligations. So people in their 40s may still be raising children, may be having to help with college. So they have other financial obligations that they can't necessarily do a policy. But the younger that an individual is, the better. Typically, we see people, 50s, 60s, 70s. There's options up to age 85, but keep in mind, the older you are, the less leverage you get. I personally bought a policy in my 30s, pre-children. So everybody's different. So it's really what you can afford. And one of the things that we do sometimes, or we suggest, is because of the financial obligations of individuals, maybe with kids in school, college coming up, is they may purchase a policy and do a little bit of coverage now and what they can afford, and then they can potentially later layer in another policy when there's more freed up cash flow.
All right, perfect. Well, that wraps up the questions that we got. So I want to thank everybody for their time today. I will be following up with everybody that attended, and I hope you found this information valuable and worth your time today. And I do look forward to having those follow-up conversations with everybody. Thank you very much, Heather. Appreciate it.
Thank you. Thank you.